Most people expect a bank shutdown to be loud and immediate. It isn't. The first truth is quiet. Systems still appear intact, screens light up, shops open on time. What changes first is not function but alignment. In the opening hours, banks avoid the word failure. Messages reference maintenance, outages, or delays. This framing matters. When explanations feel temporary, you continue routine behavior, unknowingly extending stress across systems already slipping. Payment networks absorb pressure first. Transactions don't stop uniformly. Some clear, others hang. This unevenness creates doubt, not panic. You retry, assume glitches, and move on, while coordination behind approvals degrades silently. Cash gains importance before scarcity appears. ATMs still work, but limits change. Caps arrive quietly as safeguards. The signal is subtle but powerful. Access is conditional. Ownership no longer guarantees immediate use. Businesses notice before households do. Settlement delays trigger alerts. Suppliers pause confirmations. Managers respond cautiously, not dramatically. Orders shrink, hours tighten. These small adjustments ripple outward without public acknowledgement. Employees hear little. Payroll systems depend on banks, but paydays haven't failed yet. Leadership waits for clarity that doesn't come. This delay maintains calm while committing Pleito plans built on outdated assumptions. By the second day, information gaps widen. Institutions know more but disclose less. Practical rumors spread. Which cards work, which banks clear transfers. Behavior fragments as people navigate the shared experience instead of guidance. Logistics feel strained next. Fuel distributors, wholesalers, and carriers rely on daily settlement. When payments pause, movement slows. Not because goods vanish, but because authorization hesitates, waiting for confirmations that don't arrive. Households adjust almost unconsciously. You buy essentials, you defer extras. No announcement forces this shift. Collective hesitation reduces flow. Demand falls first, supply responds later. The loop tightens without visible crisis. By hour 72, the issue is no longer banks alone. It is coordination. Trust between strangers weakens, transactions take longer. The system still exists, but its speed is gone, replaced by friction and delay. As coordination slows, informal rules appear. Some shops accept only exact cash. Others extend limited credit. These choices aren't emotional. They are attempts to preserve continuity. When formal settlement no longer synchronizes actions, queues begin forming selectively. Pharmacies, fuel stations, groceries. The lines are calm. Posted limits do the signaling. Scarcity is implied before shelves empty. Shaping behavior through expectation rather than enforcement. Bank branches become gathering points. Even when closed, people arrive seeking certainty, not cash. A locked door without explanation creates more anxiety than clear loss, because ambiguity prolongs decision-making. Digital balances feel abstract. You may know you have money, but access is delayed. This gap shifts value toward immediacy. Exchangeable goods feel safer than numbers awaiting permission. Employers face timing risk. Work continues while payment assurance weakens. Some ask staff to wait. Others promise later compensation. The effect is subtle mistrust. Attention drifts from tasks to personal security. Local authorities issue calming statements focused on continuity, not solutions. This framing prepares you For endurance, it signals that the disruption is structural, not a short outage. Awaiting a switch. Everyday transactions. Slow. Prices are double-checked. Receipts reviewed. Verification replaces assumption. The economy doesn't stop. It thickens as friction accumulates across ordinary exchanges. Supply chains favor predictability over speed. Vendors choose fewer partners they trust. Variety narrows before quantity does. Shelves may look full, but options contract under coordination strain. Media language shifts from reassurance to process. Terms like settlement and liquidity surface. Understanding remains partial, but awareness grows. That recovery depends on alignment, not announcements. By this point, behavior has adapted. Panic never arrived, but normality didn't return. Expectations reset lower. Whether stability holds now depends on restoring synchronized trust, not confidence alone. Financial institutions begin internal triage. Some obligations clear, others wait. From the outside, this looks random. Internally, it follows risk logic that prioritizes system survival over fairness or sequence. Small businesses absorb the pressure first. Limited reserves leave little room to wait. Hours are cut. Inventory thins. These decisions are quiet but widespread, accelerating slowdown without dramatic closures. Households start comparing notes, not to speculate, but to confirm reality. Which cards worked today? Which transfers cleared? Shared information replaces official guidance as the primary navigation tool. Transport schedules adjust subtly. Routes consolidate. Fewer runs occur. Goods still move, but with wider gaps. Delays feel systemic rather than incidental, signaling coordination strain rather than shortage. Credit and insurance enter uncertainty. Coverage exists, but approval's slow. This discourages commitment. Repairs wait. Travel pauses. Expansion plans stall. Economic contraction deepens through delayed decisions. The idea of later weakens. Promises lose timestamps. When future points blur, planning shrinks to the immediate. Present behavior becomes conservative, reinforcing reduced circulation across the system. Institutions communicate more often, but say less. Updates repeat without progress. Language becomes procedural. Confidence doesn't collapse. It thins gradually as repetition replaces resolution. Social behavior mirrors this. Thinning trust. Politeness remains. Patience shortens. Disputes arise over small amounts. Minor frictions reveal how much daily cooperation depends on smooth settlement. Temporary alternatives emerge. Deferred payment, informal credit, limited barter. These methods work locally, but fail to scale. highlighting why centralized coordination existed despite its fragility. At this stage, outcomes hinge on alignment. If coordination restores, activity stabilizes. If not, the system settles into a slower, narrower form, waiting rather than collapsing. Banks prepare. Partial reactivation. Access returns. In phases, not fully. From the outside, this looks like progress. Internally, it is containment, ensuring restored flows don't overload. Weakened coordination. When access resumes, usage spikes briefly, then falls. Confidence lags. Functionality. People move cautiously, aware that availability can disappear again. Without warning, businesses respond by holding buffers, extra inventory, delayed payouts, conservative pricing. These cushions reduce shock, but lock in a slower economic rhythm. Public conversation refrains the event. It is no longer an outage, but a lesson. Resilience and redundancy replace efficiency as guiding ideas. By the end of 72 hours, expectations have shifted. Nothing collapsed. Something recalibrated. What follows depends on whether coordination is restored or caution becomes permanent. The lasting change is internal. You plan with buffers. You expect delay. You value clarity over speed. The first 72 hours don't break society. They reveal its conditions. Stability, you learn, is continuously maintained. People stop checking balances constantly. Attention shifts from totals to access. What matters is not how much you have, but what can be exchanged today without delay or negotiation. Large organizations impose internal limits. Departments receive spending caps unrelated to immediate needs. These controls reduce exposure but slow operations, reinforcing the sense that permission now matters more than demand. Errors multiply. Duplicate charges. Missing records. Delayed confirmations. Each exception requires manual review. Automation gives way to human checks, reducing speed while increasing fragility. Trust narrows. Geographically, you rely on nearby, familiar providers. Distance adds uncertainty. This localization reduces efficiency, but increases perceived control, reshaping behavior without formal policy changes. Psychologically, uncertainty stabilizes. Stress becomes background noise. You adapt rather than resist. This prevents panic, but also normalizes dysfunction, making recovery harder. Once systems resume